Hello and welcome to our webinar today. Today we will speak about global small cap investing. Global small caps have outperformed large caps once more last year. And generally, this area of the market has higher growth profile than the often more mature companies in the large cap section. But an active approach can help to pick the small caps that will become the leaders of tomorrow, the champions of tomorrow early. But how do you do that in practice? How do you select the companies and which criteria do you look for? And why is it favorable to have a long-time investment horizon? So to answer this question, we have Scott Woods here, the lead fund manager of Columbia Threadneedle's Global Smaller Company Strategy. Just a few words about Columbia Threadneedle. It is a global asset manager with locations in 17 countries. It has more than $500 billion in assets under management and employs 450 investment professionals based in North America, Europe, and Asia Pacific. The company offers a broad range of actively managed investment strategies across a variety of regions and asset classes. Their clients include private investors, pension funds, and corporates. So before we start with the Q&A session with Scott, please note that you as the participants have the possibility to ask questions during the webinar. If you have a question, you can type them into the chat window on the right side, either in English or German languages. But now it's time to start with the webinar, and I would hand over to the Q&A session with Scott. So hello, Scott. Great to have you here today in our webinar.
Brilliant. Thank you very much for having me.
Thank you for being here. So I would say we start with the first question about the universe, because I can imagine that it's a very large universe to cover global small cap universe. So I wonder how high the percentage of the market you cover with your team is and how you collaborate within Columbia Threadneedle with the local or regional small cap teams. Can you say a few words about how you would cope with the very large investment universe?
Absolutely. And that's a really good question because there are 4,500 stocks within my investable universe and an extra 30% off benchmark. And so the idea that, myself and the other analysts on the global smaller companies team could go out and visit all of these companies individually, as much as we would like to, it's not really possible. And so the real critical thing for us is that we're able to work with these regional smaller companies teams that we have at Columbia Threadneedle based in London. And so rather than myself having to go out and try and identify all of the European small companies that best fit my investment philosophy, I am very fortunate that I can rely upon these regional small cap teams who have a long heritage of investing in their regional smaller companies, and also crucially have the same investment philosophy that I do. When we go into talking about investment philosophy, having that overlap and being able to source those ideas from those regional portfolios is so important. And really, what the global smaller companies portfolio is set up to be is almost like a best of the best approach of all of the regional smaller companies teams that you sort of see listed on this slide here.
Yeah, so you can really build on the expertise of the small cap teams, and then you collect the best ideas and reflect them in the global portfolio. So are you doing a lot of maintenance coverage, or is it more from the bottom up side that you develop ideas?
So it's really bottom up driven, and when we go into talking about the investment philosophy, the idea is that from a true bottom up perspective, we want to own the best of the best companies of those regional smaller teams. And so when the global small cap team sits down and we are looking for new ideas and we're looking for potential names that could go into the portfolio, the question we are really asking ourselves is this company better than something that we already own, or does it have a place in the portfolio based on the valuation and the quality of that business? So rather than trying to structure this in a sleeve based approach, which some global small cap funds do, we prefer to go from the bottom up and create this best of the best approach of the regional smaller companies portfolios.
So thank you for that. And I also come across another question about how you select the companies. You say you had a bottom-up process. So could you run us quickly through it and maybe also point out what you think, which factors make a small cap company likely to be very successful or leader in its field for tomorrow? And also, about maybe the industry it operates in, how important that is for you.
Absolutely, and those are really important questions. And so I want to sort of go over sort of the investment philosophy and talking about the sort of companies that we're trying to identify. And so we talk about trying to find businesses that we believe have a sustainable competitive advantage. And why is that important? So this chart on slide 2 here, on the left-hand side, when a company has a competitive advantage, it tends to have pricing power and is therefore able to generate a return on its invested capital above its cost of capital. So you can see on this chart on the left-hand side, this particular company at time equals 0 is generating a return above its on its capital employed above its cost of capital, which is represented by that light blue line. But what the market inherently assumes is that over time, competition will come in and erode into those companies' returns. So competitors will move into that market. And so what you will see is a degradation of those returns over time, so that company goes back to simply making a return on its capital equal to its cost of capital and creating no economic value. However, what we're trying to identify, and we do this by assessing the fundamentals of the company and the industry within which it operates, we're trying to find businesses where it isn't quite as straightforward as competitors can simply stroll in and eat into those returns, but there are structural factors why competition can't do that. And so we would deem these companies to have what we say is a sustainable competitive advantage. And so actually these companies on that chart would follow the trajectory of the purple line as opposed to the grey line. And it's sort of the idea that these businesses are undervalued based on their ability to continue to generate returns above their cost of capital in the long term. And that is what's being undervalued. So we spend a lot of time focusing on trying to identify these businesses, and not just myself, but as I mentioned before, this is the key tenet of, the investment philosophy of all those regional smaller companies teams as well. And just, when we're talking about what these businesses look like, and you're asking sort of about the industry and how we assess that and trying to work out, what are going to be these next leaders? Well, there's certain characteristics of these companies that we look for. And, I've already mentioned return on invested capital. Now, that is a function of a business's margin profile and its asset intensity. So how much capital do these businesses need to reinvest in order to maintain their competitive advantage? And the second piece is sustainability. And so, when we're talking about the sustainability of a company's competitive advantage, it's not whether that business can continue to maintain that competitive positioning next year or even in 3 years. When I'm meeting management teams and we're trying to understand better about that, how that company works and how it's structured within that industry, we're trying to think about this 5 or 10 years time. Why should this business still be able to maintain its competitive positioning? And the key way of understanding that and assessing that is using Porter's 5 forces. And we hear a lot of people talking about investing based on Porter's 5 forces, but for us, that is I view Porter's 5 forces as almost a toolkit for assessing the sustainability of a company's competitive advantage. And I'm sure we will come on to this, but definitely an addition to Porter's 5 forces for me, and it goes into sort of my investment background. I used to work for an ESG focused asset manager, is ESG, and that I almost view as an addition to Porter's 5 forces in the context of this investment philosophy. And just lastly, when it comes to industry, we are, because it's a bottom up process, I'm happy to invest in any industry, but when it comes to growth, what we're trying to look for is making sure that we're not investing in industries that are X growth or in secular decline, because that impacts the terminal value and what you'd be willing to pay for that particular business. So while when people think about small caps, they think about hyper growth businesses, I actually quite like boring businesses. I like compounders, but we don't want to invest in businesses that are going X growth.
So thank you very much for Scott. I'm just trying to sum up the Porter's 5 forces model for the audience, or maybe you can help me. I think it's about a company which has internal and external factors which offer opportunities and threats, right?
Yeah, absolutely. And so actually, this is if we maybe look on slide number 5, and so really what you're doing with Porter's 5 forces is it's trying to assess, I guess, the structure of an industry in trying to understand why you believe that company will be able to maintain its competitive advantage. So it's made up of 5 different forces. And so, when we are looking at a particular company, I will be thinking about these 5 different forces in order to try and understand why this particular business might be able to sustain its competitive positioning within the industry. So if you take, for example, SiteOne Landscape Supply, SiteOne is a landscape distributor in the United States, and its customers are residential and commercial landscape professionals they tend to be 1 or 2 pickup truck operations, and every morning they go to this SiteOne store to collect the items they need to complete the jobs for that given day. And so, when we were first learning about this business back in 2017, I was trying to look at this company through the lens of Porter's 5 forces. So, if you take the first force there, industry rivalry, and SiteOne, for example, in this case, it's the only national player in the United States. It's got 15% market share, but actually the industry itself is very fragmented. And so actually SiteOne, despite having 15% market share, is 4 times bigger than its next largest competitor, and bigger than its next 2 through 10 competitors combined. So it really dominates what's a very fragmented industry. The barriers to entry are actually quite high, and higher than you think, because what those contractors who are going to that SiteOne store every day really care about is product breadth. They just want to go to one store every morning to collect all the goods that they need to complete their jobs for that given day. And so SiteOne has over 100,000 different products that it stocks. And so it offers a one-stop shop for those customers that they can't get anywhere else. And for new entrants to be able to match that product breadth would be really difficult. In terms of the power of customers and the power of suppliers, so this business operates in what I would almost describe as an hourglass industry structure, because it is procuring its products from over 3,000 different suppliers, and it is serving a very fragmented customer base of over 180,000 different contractors. So it's often its supplier's biggest customer, and all of SiteOne's landscape suppliers customers are very small. So the company is able to leverage purchasing economies of scale over its suppliers, and none of its customers are able to leverage purchasing economies of scale over SiteOne. So, and then the last piece is threat of substitution. And, this goes back almost to what I was talking about, the investment philosophy before, and the threat of competition. Now, this is a distribution business, and for many distribution businesses in the United States, there is a quite credible threat that Amazon is going to disrupt a lot of these businesses. But again, this is where doing the fundamental research is so important. And we've been to multiple SiteOne stores, and I've been, spoken to lots of their customers, and, you get a better understanding of why actually this business is less susceptible to disruption from online competition than you might think. And immediately when you think about the types of products they're selling, which is compost, nursery trees, paving slabs, these are big bulky items that don't really fit quite as well into that Amazon distribution model. There's also lots of fertilizers in there as well that again would require a change in sort of that Amazon distribution setup. And secondly, it's just the nature of the way the customer buys. He doesn't know what he's going to need for his jobs the next day until he's basically completed the previous day's jobs. He then goes back and repeats and buys what he needs. And so the Amazon model is, I'm going to have to order in the middle of the day to get it delivered tomorrow, but I have to specify a place, and I don't know what time it's going to be delivered. So the models don't really overlap that well. So, I know it's quite a long answer to the question, but it's important because, you can see here by analyzing a business on Porter's 5 forces, we are trying to get a better understanding of why we believe that business does have a truly sustainable competitive advantage that we think can endure over the long term.
Thank you very much, Scott. I think this was an excellent example to point out what you are looking for in companies. Some may also know the concept as the concept of economic mode, which is similar to that. It is a company has sustained competitive advantage to keep the competition at bay. Now let's look at the criteria, and we have already touched on that for evaluating these companies. We've already touched on that maybe these very high growth companies highly geared in fast changing environments and that are barely profitable are not the kind of stock you look for in the fund. So you look more, I think, for quality companies. But so I wanted to ask you, how important is growth for you and how important is quality for you, and what factors you look at, and also maybe valuation. How do you assess valuation of the companies?
Sure. And so when it comes to growth, I mean, I think about this fund more as much more focused on quality. When we are trying to find businesses that we believe are undervalued based on their ability to generate returns above their cost of capital in the long term. We're not trying to make a call that this business is going to grow faster than people expect over the long term. So I always think, people talk, and they bundle quality and growth together. Actually, I think about this fund as more quality at the right price. We're trying to identify businesses where the market has underestimated the ability of this business to generate returns ahead of its cost of capital over the long term. And so when we are modeling businesses, actually, this is actually really important, because we model businesses trying to identify where these businesses are undervalued. So we look at modeling companies based on a longer term DCF, so a 10-year DCF. And the reason we do this is, we don't try and beat near-term numbers. I think there are lots of people trying to do that maybe on the sell side, and there is a lot of macroeconomic factors that are very influential that I don't think we have a really strong ability to try and, out-predict might be the term. So, I'm much more focused on, if we assume the company, meets its consensus earnings over the next few years, but we believe this company can generate the same returns or even improving returns profile over the longer term, what does that tell you about the valuation today? And so if we model a company to have sustaining returns and the intrinsic value that we determine is below where it's trading today, that would tell us that the market currently is underestimating the ability of this company over the longer term to generate returns on its cost of capital. So, I think about this as much more focused on quality as opposed to growth. Now, when it comes to growth, we're not ignorant of it. We want to make sure that we are not investing in businesses that are going X growth or in structurally declining industries, because that would lead to a very, very small terminal value in your DCF. So, but I think the thing that I always have to try and separate here is when people are thinking about small cap, they think about hyper growth businesses. They think about businesses growing 40% year over year. And while we have examples of that within the portfolio, the reason we own those is because we believe the returns profile of those businesses is sustainable over the long term, as opposed to we think it's going to continue to grow at that particular rate over the long term. So I think it's important to separate the two, and it's really for us a focus on that quality at the right price.
Okay, thank you very much, Scott, for that. You also mentioned your long-term time horizon to investing. So my question is, no, I just want to say that your portfolio has multiple year holding periods, which result in low turnover. But the question is, why do you think investment with a long-term approach is critical for success, especially in small cap? And are there reasons when you would sell a company early?
Absolutely. And so I think when we go to thinking about small cap, and particularly about this investment philosophy, we're talking about the ability of these companies to compound returns ahead of their cost of capital in the long term. And even if you go and look at this slide that we were talking about at the beginning in terms of that investment philosophy, almost from a visual perspective, you can see sort of the alpha opportunity, as it were, as the difference between those purple and grey lines. And it's much wider in those outer years because, as that company continues to compound returns above its cost of capital in long term, that's where the true undervalue, misvaluation of that company is. So, I think owning these businesses for the long term and enjoying the compounding effects of their returns above the cost of capital is really important. And, you think about when the investment time horizon, how we're thinking about these businesses, we're trying to understand why these businesses have sustainable returns over the very, very long term. So we want to own these businesses, enjoy the compounding effects over the long term. So the other thing to tie into that is shorter term. There are lots of fluctuations, and that can be positive and negative for us, but what it can do is it can provide opportunities. Over the near term, lots of companies that we own can be influenced by lots of different factors that are very, very difficult to predict. And so while some of them can be favorable for the stocks and some of them can be a bit more unfavorable. So we try and use that, that volatility to try and, in terms of from a portfolio construction standpoint, add to those companies that are weaker and trim those companies that have been a lot stronger. So you even take a great example would be last year. We had a really, really large drawdown in March as a result of the coronavirus. And so what it gave us an opportunity to do, because we've got this long-term focus, is, look at companies that may have halved in price, but actually were still very, very good businesses from a long-term perspective and had really great characteristics, businesses we've owned for a long time, we want to continue to own. It was a great buying opportunity for those kinds of businesses. And so having that long-term tilt, I think, can really help from that rationality from a portfolio construction standpoint. So I think that's really important. In terms of when we're going to sell businesses, there are a couple of different reasons. Now, this is a small cap fund, and we're hoping that all the businesses we own graduate out of that small cap universe and into the more of that mid cap space. And so we have an upper limit of $10 billion market cap, which is defined by the MSCI Global Small Cap Index. Now, we don't sell the second those companies hit $10 billion. We look to continue to own those companies until they reach our price target. We don't start any new positions in companies with a market cap above $10 billion. The other reason we might sell is valuation. Stocks do get expensive based on our DCFs, and at that point, you would say that the market is fully pricing in the ability of these companies to continue to maintain their returns above their cost of capital. We're certainly not in the business of owning things for more than they're worth. So once those companies reach our price target, we're going to look to trim and eventually sell those companies. And the last and actually probably the most important thing is if you see a deterioration in that company's competitive positioning. It doesn't always happen quickly. It can happen slowly. But if we see, a company's returns on its invested capital being challenged by competitive factors, that company no longer fits our investment philosophy. So we're going to look to sell that business because it no longer fits within sort of that within that investment philosophy.
Okay, thank you very much, Scott. Before we move on to the next questions and to the performance part, I just wanted to sum up the key points for the participants quickly. So the fund invests in global small caps with an upper market cap limit of 10 billion euros, which is not a fixed limit, but it's when the companies are bought that they have no higher market capitalization than that. And companies are sold when they reach a target price or the fundamentals deteriorate. The focus is on finding the best ideas, and therefore Scott has the possibility to work with his colleagues, his colleagues in the regional small cap teams, like Columbia Threadneedle, where he can collect their best ideas and reflect them into the portfolio. What is also very important to him is quality. First, that the companies should have sustainable revenue. And here they do prediction like 10 years in the future with their DCF models to value those stocks. And also certain competitive advantage. So it's really important that not only it's a good company, but that it is in a market environment where it can grow, which is not in too much decline, and where they are able to defend the competition. For example, through high barriers of entry, through a fixed client base, or through products that are not easy to copy. Like the example he said with the landscaping supplier, where Amazon cannot step in so easily because people decide on the day they buy the goods what they really want to buy that day. So this is a very good example for that. And then the holdings are reflected into the portfolio, where they remain for multiple year time horizon until they reached their price target. So then I would like to move on with the next question about the performance of the Global Small Cap Fund. So Scott, could you speak a little bit about the excellent performance of the fund in the past and what has added value? And also if there were stocks that did not meet expectations? And could you please give us some examples for the return drivers and maybe also some cases where you sold companies over the last year?
Sure, absolutely. So the performance has been really strong, which is reflection on the strength of those regional smaller companies teams, and also on that investment philosophy. When we think about performance, I'm much more pleased about the longer term performance, because it more closely matches sort of my investment time horizon. When we invest in businesses, we want to own them for 5-10 years, and when we start talking about some of the examples, we've got lots of companies that we've held in the portfolio since inception. So, those longer term numbers are more reflective of our investment time horizon. But, you can see the performance has been good over multiple different time horizons. When we talk about the performance, for me, I'm not trying to, this is a bottom up process, and we are not trying to generate any performance from, from regional and sector allocation. The key thing for us is about stock selection. And so, there are going to be some years where, because of this bottom up process, we are always going to be over and underweight certain regions and sectors, but that's not how we're trying to generate performance. It's all about that stock selection. And the pleasing thing about this performance is that the primary driver has been stock selection over that longer time period. So that has been really, really pleasing. In terms of stocks we sold, and I guess we've actually I always find that you do learn almost in many ways more from the stocks that you sell or things that don't work out. And a great example might be Stericycle, which was actually one of the companies that I first started covering when I joined Columbia Threadneedle. Now, while it was many years ago, this was back in 2016, it was a bit of a darling of the mid-cap industry, and it was a very, very high quality name that was engaged in medical waste disposal in the United States. And so, there were some telltale signs that things were changing in terms of their competitive positioning. They were starting to see pricing pressure as their customers consolidated. So, from a Porter's Five Forces standpoint, that bargaining power of the customers was becoming more difficult for the company. And also the company made a returns dilutive acquisition, and that almost harks back to ESG. And we talk about governance, and we talk about the idea of bad governance potentially leading to diminishing returns on capital. That would be a great example of that. But I always find the companies that you sell or where things change, you tend to learn maybe more than the ones that do very, very well. You tend to spend more time focusing on those probably. So lots of examples of that. But it's all we don't advertise of getting every single stock right. We get stocks wrong. It's learning from those and applying that to new names and going forward. But luckily, there've been more, I guess, winners than there have been losers over the longer term.
Yes, thank you very much for that. The returns are impressive, but it's not only the returns of the strategy. We have also seen that it has also done well on the risk side. So the overall risk indicators was lower than peers. So could you tell us a little bit about the reason why this was the case?
Absolutely. And so on this slide, we've got the upside downside capture of the portfolio. And I think one of the things that surprises people when they start looking at this strategy is actually the fund has performed in more down market months than it has up market months. Sorry, outperformed in more down market months than it has up market months. Well, we have outperformed in both. You can see on this slide here, on this bar chart, that in almost 78% of down market months, the fund has outperformed. So why is that? Now, I can't give you a direct reason. I can only give you sort of the empirical reasoning that I think of as why, and link that back actually to last year. So if you consider the types of companies that we're investing in, they are those with very, very robust business models. We mentioned sort of they've got high returns on their invested capital. So that means they've got high margins and they tend to generate a lot of free cash flow. Many businesses we own have high degrees of recurring revenue as well. So when you think about sort of, when you have periods like last year in March, when people are very, very worried about businesses being even a going concern, you've got businesses with very, very low margins and high amounts of debt, you might be quite rightfully concerned, are these businesses going to go bankrupt? And what that creates is a bit of a flight to quality effect where, people want to invest in businesses they don't think are going to go bankrupt. I think that's fairly rational. And so I think you get this flight to quality effect. And it's something that we certainly saw last year. We highlighted the really strong performance that the portfolio saw in 2020. You can see here, a large degree of that was driven by the performance in March when we had that large drawdown, because, lots of the companies we invest in are, like I said, very, very tried and tested business models. They generate a lot of free cash flow that they're going to pay off their liabilities. And so I think you get that flight to quality effect, which is actually, I think, has also meant that that sort of risk reward profile looks quite favorable for the portfolio, and why, if you look at our information ratio versus our peer group, we're the number one by quite a distance.
Thanks very much for walking us through performance. One thing that came to my mind is when also thinking about the 5 forces model, the COVID crisis, it was not something that was predictable or something that happens very often. So has the crisis affected some business models within your portfolio positively or negatively? Can you give a few examples for us and what you have done with these companies or the stocks portfolio?
Sure, no, absolutely. And maybe actually, I can actually give a good stock example here, actually. It's a good stock example just to identify process as well. So, look, I think, there are lots of companies that, would find now that their business models maybe are even more challenged than they were beforehand. So I think, there's always been an acceleration of trends. On the negative side, there's lots of companies that might be some bricks and mortar retail businesses and other types of business where actually their industry is, I guess, it's brought forward some of those challenges that they might have deemed to be a bit further down the line. But because of our investment philosophy, we want to invest in, good businesses that we believe, or in fact great businesses that we believe are being undervalued. I guess that isn't really an area of the market that we find a lot of ideas that fit our investment philosophy. So, we were a net, I guess, beneficiary of lots of things that were going on last year. One of those might be, the increasing shift to online, and we own lots of software businesses because they tend to have a lot of recurring revenue, and this trend to digitization, is very, very powerful, and that obviously got accelerated. Another one would be the increasing shift to e-commerce, and you take, for example, Cargojet. Now, this is a business that we've owned in the portfolio since 2017, and Cargojet is Canada's provider of overnight air freight. Now, when you first think about this business and you think about an overnight air freight operator, it doesn't exactly ring out that this is a business with a strong competitive advantage. But the really interesting thing about this business is that it's got a monopoly position. So it controls 95% of the overnight air freight market in Canada. And the company is essentially taking all the freight from the major freight forwarders like DHL and UPS, and it transports it across Canada overnight on a co-load basis. It's very difficult for new players to enter the market because they would struggle to match the profitability on any given route and would basically be unable to generate sufficient volumes to make it worthwhile and would operate at a significant loss. There are also some regulatory barriers to entry that prevent international airlines flying point to point within Canada. And so, the network itself, because of Canada's large market, large geography, has got over 20 planes. The company's got 7-year average length contracts and very, very long-term relationships with its customers, and a 99.8% track record. So it's a really, really dominant competitive positioning. Now, we invested in this business back in 2017 because, a lot of the growth is being driven by e-commerce volumes. And so you consider one of the interesting things we learned when we were doing the initial research on this company was that Amazon Prime wasn't particularly well penetrated in Canada. And so the reason for this was that Amazon didn't have a way of actually effectively doing next day delivery in Canada. So Cargojet offers a really, really good way for them to do this. And actually in 2019, Amazon did take a stake in this business. But if you look at the strong performance of Cargojet last year, a lot of that was driven by increased e-commerce volumes. And you think about, the way that, I guess, the behavior of the consumer now is much more comfortable with buying their goods online. And you've seen that, I guess, that demand almost being pulled forward. The management team at Cargojet spoke about 5 years of change in 6 months in terms of that shift from bricks and mortar retail to online. So, we saw lots of, this is a very, very specific example, but we saw lots of these trends being pulled forwards. And so I think for the most part, it was a big beneficiary of a lot of the companies that we invest in.
Okay, thank you very much for that excellent example of that freight airline, which has benefited from the COVID trend, which would be, for me, it would have been counterintuitive, but when you look at the fundamentals, then it's pretty clear. But next, I would like to have a look at the portfolio, how you positioned, and maybe you could tell us a little bit about your positioning and about your top investment ideas.
Sure, absolutely. So if we look here on slide number 8, you know, this gives a bit of an overview of the portfolio today. I think the first thing when you look at this top 10, and the thing to highlight is that it's a very, very diverse range of pretty disparate businesses. I think maybe some of the most interesting ideas that I'd probably highlight from this list, I think Altair is definitely one that, is a really interesting name. So Altair is a US designed software company. So it provides simulation software to its customers. So for a good example would be, I guess the company's genesis was, when you see those videos of people crashing cars into walls and seeing the impact on test dummies, that's quite a laboursome and I guess not a particularly accurate way in many ways of doing it. It's much better to do it using simulation software, which is cheaper and can often be more accurate. And so this company has its background in doing that. And so simulation software has got good structural growth trends, as you see growing adoption for more use cases and also more users. And the second part of it is that it's got very high barriers to entry. The algorithms that are used to simulate these real world forces on the computer are very, very complicated, and they're getting better over time. And so the company operates in what is essentially a duopoly with good structural growth, and it has very, very high retention rates because companies, engineers and designers are trained to use Altair software. So that's a really, really good name, and again, one that we've owned in the portfolio for quite a long period of time. Another really interesting name is Ritchie Brothers Auctioneers. This is a name we've owned since 2013. So Ritchie Brothers is an auctioneer of used industrial equipment. So the way to think about this business is that it is almost like Sotheby's or Christie's, but instead of selling artwork, this company is selling things like tractors and diggers, cranes, and large, heavy, big pieces of industrial equipment. The interesting thing about Ritchie Brothers is that it's the largest player, and so that develops a network effect. And when people think about network effects, they think about Facebook and Visa and MasterCard, but there are lots of great examples in small cap as well. And so Ritchie Brothers, because it's the biggest player in the industry with about 20% market share today, that attracts the most number of buyers because they know that there is going to be the most amount of equipment at a given auction. So they get broader choice and they think they might get the best price. At the same time, the sellers want to go to the auctions that have the most number of buyers because naturally they want to be able to achieve the best price and make sure they sell their equipment. So that breeds up a sort of a virtuous circle. And, I've been to one of the auctions in Rotterdam, and you talk to customers and, that's what they're telling you. They want to make sure they get the best price and they want to be able to sell their equipment. So Ritchie Brothers is a great name. We've owned it for a long time within the portfolio. And if we talk about where the portfolio is positioned today, and we look on slide number 9, I alluded to this a bit before, but this is a bottom-up process. And so from a regional and sector basis, I'm not trying to generate performance by being underweight or overweight certain sectors and regions. You can see, for example, we're underweight North America and overweight Europe ex UK, but that is a function of the opportunity set. We found more names that fit our investment philosophy and crucially are trading at an attractive valuation within Europe ex UK than North America. But that, over the next 3 to 5 years could easily change as, depending on where we find those ideas. And the same thing applies from a sector basis, but there is a bit of a caveat because naturally this investment philosophy does favor certain sectors over others. We struggle to find banks that we believe have a truly sustainable competitive advantage. We don't find many companies within energy or utilities. Energy is a commodity-driven industry. It's hard for companies to generate returns above cost of capital. Within utilities, their returns are regulated by the jurisdictions within which they operate. However, within industries like technology and industrials and healthcare, these are innovative industries. Companies are able to carve out a niche and build an economic moat around their business. And so we do find, not for lack of looking in those other industries, but we tend to find more businesses that fit our investment philosophy within those sectors. So, going forward in terms of where we're positioned, it's just, it's a continuation of this theme of trying to find those businesses we deem to have the most sustainable competitive advantages on a global basis at the right price. And just one more point, just to cover off sort of on performance, and a lot of the names that in the way we're positioned today, a lot of these names we've owned for a long period of time. Last year, although there was slightly increased turnover last year because of the increased volatility in the market, we were having to sell some businesses that have gone above our market cap range, and we were finding better opportunities elsewhere from a valuation perspective. A lot of these names that you see in the portfolio in that top 10 have been businesses we've owned for, a significant period of time. Altair has been in the portfolio since 2018. We've owned Ritchie Brothers since 2013, Blackline since 2017, Nihon M&A since 2013. So, the great thing about this is there's lots of names we've owned for a really long period of time. And even when you look at the performance last year, and you look at the top contributors to performance, it was actually names that we've owned for a long period of time that were really leading the charge in terms of performance. It wasn't us being reactive and trying to find names that we felt were COVID beneficiaries. Names like Cargojet, which is one of the biggest contributors to the portfolio, had been in the portfolio since 2017. So I think it's really, again, goes back to that long-term, we try to think about portfolio positioning, about owning those best of the best companies, rather than we are positioned for this particular environment or not.
Okay, thank you very much for that, Scott. I'm just summing it up for our participants. So performance last year was excellent, which was also driven by the approach of the managers looking for quality. And during the pandemic, even those businesses, because they have competitive advantages, they did quite well overall, better than the overall market. And also the returns are mainly driven by the individual stock returns, by the stock picking. And many of those stocks have been in the portfolio for multiple years already. So the portfolio hasn't adapted much during the pandemic, because many of these companies were already in there, which did well. And also this type of company Scott looks for usually has a lower risk, which can also be seen in the lower risk figures of the portfolio. For example, you've seen on the slide that it is a beta of around 0.8, which is a measure of a kind of the elasticity when the market falls, that the portfolio usually falls less, which is a nice feature. So then when we have also seen the portfolio, and there also, due to the approach, you can see it in the sector allocation of the portfolio, because in some sectors, the fund has practically no holdings, because these kind of company doesn't fit the investment criteria. For example, in energy, the returns are a lot driven by market price movements, which aren't predictable very well or at all. So there is a preference towards companies out of sectors like technology, healthcare, or industrials. So that was a short summary from my side, and then I would like to move over to the outlook. So, Scott, could you give us an outlook on the small cap segment, what you expect it to do over the next year? And do you see any threats for a certain kind of company or industry upcoming on the horizon? And are there areas also where you see new opportunities for companies? And what you look for?
Sure, absolutely. So, I think, over the next year, it's going to be, definitely be really, really interesting. But I always struggle to predict, I guess, from performance from year to year. I think if you told me this time last year what would have happened in equity markets given coronavirus, so that they would have probably ended the year even higher, I might have been a bit surprised. So I always find it difficult to predict, what's going to happen from an equity market standpoint from year to year. But, when I look at things holistically, I think you're certainly going to continue to see that small cap effect over the longer term. I think it's pretty well known that you see that, that longer term outperformance of small cap over large cap, and I don't think there's going to be any reason for that to not continue. Although this portfolio is lower beta, people do view small cap as a higher beta asset class. So if there is a strong recovery, that could potentially lead to stronger performance of small caps over that period. But it's something, again, I don't focus a huge amount on, but that is something that you could potentially look for. In terms of industry and sector, again, for me, I focus more on that bottom-up approach and trying to find those best of the best. There are definitely going to be industries and sectors that are going to be challenged, but I think it's hard to necessarily get a strong opinion on, which specific ones are going to be hurt. We are just trying to focus on those brilliant companies that are going to be, I guess, the long-term winners, those businesses that we think have really strong business models that can endure over the next 5 or 10 years. So rather than focusing on maybe the industries that I think are maybe more difficulty, I try and focus on those businesses that we think can really sustain their competitive positioning over the long term, and industries that have good, strong structural growth prospects. Because, one of the things that we didn't touch upon was, the idea that within small cap, you do get these, I guess, these pure play exposures to secular trends that you want. And one of those names, for example, might be Freshpet, which is a US manufacturer of organic refrigerated dog food. Now, we know that the spend on pets has been going up, by mid-single digits every single year, as consumers are willing to spend more on their pets. And I certainly know over the past 12 months, a lot more of my friends have been buying puppies and so on. And I'm sure when I go out walking, I'm seeing a lot more puppies, I think, than I've ever seen. But this has been a long-term trend, and we know that spend on pets is going to continue. Now, if I want to get that exposure from a large cap company, I could try and buy one of the large consumer packaged goods companies, but you're also going to get exposure to maybe other parts of the business that you're less interested in. Whereas, I own Freshpet, and we've owned that since beginning of 2018. That's a business where, it's a pure play exposure. The only thing that company does is sell organic refrigerated dog food. So I think one of the other real positives from a small cap perspective in terms of that performance and outlook is that, you do get these pure play exposures to secular trends that you like.
Yes, thank you very much, Scott, for running us through that example. And yeah, you can see a shift toward people having more animals at home, more pets at home, and they need food, of course. And it's a trend that will continue because people maybe also have the possibility to be home more often, to have more time for the pets. So this is really a driver that maybe has accelerated also over the last months. So then thank you very much for that outlook. And thank you very much for answering all our questions. I found it really interesting, and I think looking for quality is a really good idea in small caps, which, as you said, are usually a more volatile sector of the market. Thank you very much for walking us through our process and for being here today. And I also wanted to say a big thank you to our audience today. Thanks for being here and your interest into our webinars. If you have any comments or questions, or if you receive the materials or presentation, if you haven't given us your consent before, just get back to us and we can send you out the materials. So thank you all, and I wish you all a good day, and see you at one of our next webinars. Goodbye.
Thanks, everybody. Thank you.
Bye, Scott.
Bye.